All right, let's get right into it. Today, we're breaking down Amalgamated Financial's fourth quarter earnings call from back on January 22nd. The company put out some numbers that really got the market's attention, sending the stock for a pretty nice ride. So what exactly was in that report that investors liked so much? Let's dig in.
And boom, there you have it. That's the market's immediate reaction. A stock pop of nearly 7% on the day they announced. Now that is not a quiet little jump. Investors were clearly thrilled with what they saw. The big question, of course, is why? What was the fuel for that fire?
Well, it really all starts with a clean beat on both the top and bottom lines. Core earnings per share came in at 99 cents and adjusted revenue was just shy of 88 million bucks. Both of those numbers sailed right past what Wall Street was expecting. For any bank in this kind of environment, that's exactly the kind of headline you want to see. Okay, so a headline beat is great news, for sure. But the real story, the why, is always buried in the details. So how did Amalgamated actually pull this off? Well, it really all boils down to one thing they do exceptionally well: gathering deposits. And when I say exceptionally well, I mean it. The sheer scale here is kinda staggering. The bank pulled in nearly $1 billion in new deposits in a single quarter. The CEO even called it absolutely incredible for a non-election year, and yeah, it completely shattered their old record. This deposit growth is the engine that's powering the whole operation.
And this wasn't just some fluke from one single area. The growth was incredibly broad-based. Look at this. Nonprofits dropped a huge $388 million, another $122 million from social and philanthropy, and you've got strong growth from their climate segment too. It's just so clear that their whole mission-aligned model is giving them a serious competitive edge.
So, what's the result of all that successful deposit gathering? Well, you get what analysts love to call a fortress balance sheet. Their on-balance sheet deposits climbed to $7.9 billion, and the funds they manage for clients, that's off-balance sheet, surged to $1.1 billion. This gives them this massive, super stable, and importantly, cheap source of funding.
So why does all this deposit growth matter so much? Well, it feeds directly into their profitability through a really key metric called net interest margin, or NIM for short. Put simply, it's the bank's profit margin on its loans. By bringing in all those low-cost deposits and then lending that money out at higher rates, Amaral was able to expand its NIM to 3.66%. That is a crucial sign of health that investors just love to see.
Now, look, it wasn't a flawless report. Management was pretty upfront about what they called isolated credit challenges. Specifically, there was an issue with one borrower in their DC multifamily loan book. But here's the key takeaway. The market clearly decided to look right past this, focusing instead on the huge operational strengths and the company's confident guidance.
So with the really strong quarter in the rearview mirror, the focus naturally shifts to what's next. Management laid out a very clear plan for 2026, and it signals a strategic pivot that's really designed to capitalize on all this momentum they've built up.
Here's the playbook, plain and simple. They're selling off about $200 million in lower-yielding traditional securities. And what are they doing with that cash? They're plowing it right back into higher return assets, specifically funding new loan growth and expanding their C-PACE portfolio, which focuses on these commercial property energy efficiency projects. It's just a really smart capital allocation move.
And that strategy is what's backing up their confident outlook for 2026. Management is guiding for net interest income to land somewhere between $327 and $331 million. They're also targeting steady loan growth every single quarter, between 1.5% and 2%. Now, these aren't just keep the lights on numbers. This is guidance for continued disciplined growth.
So, we've seen a strong quarter and a confident outlook. But how does this performance really stack up against the competition? Let's zoom out for a second and compare Amalgamated's performance to the rest of the regional banking sector. The outperformance here is just undeniable. I mean, look at this. Over the last 3 months, AML delivered a total return of over 34%. Now compare that to the KRE, which is a big ETF that tracks a bunch of regional banks. It returned just over 10%. This is not a company that's just getting by in a tough sector. It is actively and clearly thriving. So what's their secret sauce? Well, they are executing the classic regional bank playbook to near perfection. Step 1, stabilize and grow your deposit base. Check. Step 2, maintain disciplined credit quality. Double check. And step 3, improve your margins as your funding costs start to normalize. Triple check. It's a simple formula on paper, but clean execution is what separates the real winners from the rest of the pack. All right, the Q4 numbers are in the books. Now for our favorite part, our take. What should you, as an investor, be looking for as we head into the next earnings call?
This really is the central question, isn't it?
After a quarter this strong and a stock run this impressive, can they keep the momentum going? We happen to think the fundamental drivers are still very much in place.
So, for their Q1 2026 report, here's our forecast. We expect net interest income to actually beat the high end of their own guidance. We see that net interest margin continuing to expand as the benefits of loan repricing flow through. And we're predicting loan growth is going to hit the high end of that 1.5% to 2% target range, all fueled by that smart capital redeployment we talked about.
So what's the core investment idea here? What's our outrageous but plausible thesis? We believe the market is still pricing Amalgamated like it's just another generic regional bank, and it's completely failing to recognize the transformation that's happening. This isn't just a bank anymore. It's becoming a specialized growth engine, using its CPAY strategy as an arbitrage to deploy low-cost deposits into high-return, socially aligned assets.
Based on that whole thesis, the strong execution we're seeing, and the clear momentum behind them, our rating is a confident outperform. We believe the market is going to continue to re-rate this stock higher as the company keeps delivering on its 2026 targets and as the true power of its unique business model becomes even more obvious.
And of course, we have to close with our standard disclaimer. This analysis is for informational purposes only. It is not financial advice. Please be sure to always conduct your own research before making any investment decisions. Thanks for tuning in.